Hey folks, David Frost, LazyGapTrader.com. In this video, we're talking about day trading, but more specifically, we're talking about gap trading. Gap trading is by far the single most consistent and profitable day trading strategy you can find across the markets today. What I do is teach a course, and within the course, I have two specific gap trading strategies that I teach. The first one is known as the morning gap trades. We're going to take a look at a couple of morning gap trades in this video. The second strategy I teach are gap fill trades, when stocks are gapping higher or lower at the open. Normally, as a result of an earnings announcement or some other news-related event, it creates an opportunity for traders that can identify a specific price level where that stock should have a price reaction in the other direction. That's what the morning gap trading strategy is. The gap fill strategy is when stocks are coming back at some point in the future to fill these gaps that are left open. It creates another tradable opportunity. I teach in my course how to track them. I teach how to trade them. I teach everything traders need to know in order to trade the gaps successfully. The other thing I do is offer to traders that want them my gap trades each and every morning. They come out at 9 o'clock a.m. Eastern Standard Time, 30 minutes before the market even opens for trading. Here's this morning's list, and as you can see, there was 6 potential gap trades on the board today. We had WR, Westar Energy, we had Mednax, PM or Philip Morris International, United Rentals, Blackstone Group, and Foot Locker. So far today, 2 of these potential gap trades hit their levels and they played out, and we'll take a look at the charts in a minute. The other ones did not. When stocks do not hit their gap levels that we're willing to take a trade at, they just become no trades. So the 2 that hit their levels today were United Rentals and Foot Locker. The rest of the trades on the board just become no trades. We're not interested in trading levels unless they hit our specific price objectives. Let's dig into the 2 that hit their price objectives today. URI was the first one. I say gap lower. Support levels are $111.19. And then I give 2 additional levels that would provide support if the stock traded lower than the first level. Stop and profit target is about 55 to 90 cents. This is a minimum profit target. We'll look at this chart in a minute. The second one that hit its level was Foot Locker. Gap higher. Resistance levels are $76.04, and then I give a secondary level. Stop and profit target is about 30 to 65 cents. In addition to these, I give a laundry list of potential gap fill trades that are viable for today. I keep a running total for my members of all the stocks that gap higher or lower each and every day, and then I give out about 30 or so each and every morning with the morning gap trading list. Let's go ahead and dig into a couple of charts. So here's a short-term 5-minute chart of URI. The stock closed yesterday at $119.51, up in this area here. Today, the stock was opening at $113.74, qualifying for a potential gap trade, and it obviously traded lower. The level identified, and this is the same level that any student that has taken my course would have gotten as well, $111.19. You can see what happened. The stock came into that level. As soon as it hit that level, it immediately bounced higher. The first time, you can see here, it missed the level, making a low of $111.23. But it did come into the level and made a low of $111.06 and immediately traded higher. Just about 15 or 20 minutes later, the stock was trading at a high of $113.50. That's a very, very nice bounce on a trade like this. These are scalp trades. These are trades that are meant to be in and out. We're not looking to hold these stocks all day. We're not looking to make $10 out of the stock. We're looking to make our profit and get out. As you can see, the stock came back in and went back higher. And what this is showing you is the importance of this price level that I teach you how to calculate in my course at LazyGapTrader.com. These are price levels where stocks will naturally be drawn to and have price reactions from in the other direction. Now here's a chart of Foot Locker. This trade is a little bit different, although it did work out. However, the stock is continuing higher. Let's take a look and pick it apart a little bit. First of all, it's a short trade on a day when everything in the market is up and inflating. That makes short trades just that much more difficult. The level identified was $76.04. And as you can see, the stock pretty much all morning long was perpetually moving higher into that level. Once it hit that level, it pierced through by a little bit, making a high of 76.07. And then in the next 10-minute candle, it made a low of 75.76. If my math is correct, that represents a possible gain of 28 cents. We were looking for 30 as a minimum. However, anybody in this trade would have certainly not taken a loss because as the stock moved higher, we were in the money. Therefore, you would have taken, at worst, a break even. But the point here is that you still see the price reaction from the important levels that you learn how to calculate in the course at lazygaptrader.com. Now the stock is still within the stop loss limitation and it may come down and trade below 76.04 later in the day. Either way, the point is that stocks trade to important levels and have price reactions from important levels. And you can see that on display each and every day in these videos about gap trading. Folks, if you want to learn this strategy, come over to check out the course. lazygaptrader.com. I can teach you everything you need to know to build a strategy that is repeatable and consistent day in and day out. I'm David Frost. Thanks for tuning in, traders.